I spent $1,000 in 2 different banking systems for 30 days, and the results shocked me. My traditional bank earned me 83 cents in interest and charged $35 in fees, while the fintech alternative earned me $7.50 and charged 0 fees. In this video, I'm breaking down my real-world experiment that proves how switching from traditional banking could save you over $500 a year. I'll show you exactly which apps I used, the hidden gotchas to watch out for, and the simple 5-minute setup that could literally pay for your next vacation. Setting up our $1,000 banking experiment. Did you know the average American loses over $500 a year just by keeping their money in the wrong place? That's right, your hard-earned cash might be slowly disappearing without you even realizing it. I wanted to see this for myself, so I decided to put traditional banking head-to-head against the new fintech alternatives in a real-world showdown. Here's what I did. I took $1,000 of my own money and split it right down the middle. $500 went into a standard checking account at one of America's largest traditional banks. I chose First National Bank for this experiment because their fee structure and interest rates represent what most Americans experience. The other $500 went into a combination of fintech alternatives, a high-yield savings app offering 4.5% APY, a neobank with no monthly fees, and a peer-to-peer payment platform for transfers. This wasn't just about watching the money sit there. I actively used both banking systems for my everyday financial life over a full 30-day period. Every coffee purchase, grocery run, utility bill, and friendly Venmo request was duplicated across both systems. When I needed to transfer $40 to my roommate for utilities through my traditional bank, I sent the exact same amount through one of my fintech apps. When I deposited my paycheck, I split it evenly between the 2 systems. The shocking part? Most people have absolutely no idea how much money they're leaving on the table by sticking with traditional banks. We've just accepted that banking means minimum balance requirements, maintenance fees, and interest rates so low they might as well be 0. It's like we're all frogs in slowly boiling water, not realizing we could jump to a much better pot. Let me break down exactly what metrics I tracked during this experiment. First, interest earned. How much passive income did each banking system generate from my money just sitting there? Second, fees charged. Everything from monthly maintenance and ATM fees to transaction costs. Third, time spent. I meticulously logged every minute I spent managing my money in each system, including travel time to physical branches. Finally, user experience. I rated each interaction on a scale of 1 to 10 for things like convenience, clarity, and customer service. The traditional bank I chose charges a $12 monthly maintenance fee unless you maintain a $1,500 minimum balance or have direct deposits totaling at least $500 per month. They offer a measly 0.01% APY on their standard checking account and 0.03% on savings. Their ATM network is decent, but using out-of-network ATMs costs $3 per transaction plus whatever the ATM owner charges. Wire transfers cost $25 domestically and $40 internationally. On the fintech side, I used a combination of services. My neobank charged 0 monthly fees with no minimum balance requirements and offered 1% cashback on all debit card purchases. The high-yield savings platform provided 4.5% APY with no restrictions on transfers. The P2P payment platform allowed me to instantly send money to friends with no fees, as long as I didn't need expedited transfers. What makes this experiment different from others you might have seen is that I used real money in real situations. This wasn't a theoretical comparison of interest rates on a spreadsheet. This was me standing in line at a bank branch for 45 minutes to resolve an overdraft fee, while my friend used his neobank app to deposit a check in 30 seconds from his couch. This was experiencing the actual friction and frustration that comes with traditional banking alongside the convenience of fintech. I tracked every single transaction meticulously. When I bought groceries, I split the payment between my traditional debit card and my neobank card. When I paid my rent, I used both systems to transfer the money. When I needed cash, I withdrew from both traditional and neobank-compatible ATMs. The importance of using real money in real situations cannot be overstated. Banking isn't just about the numbers on a screen. It's about the entire experience. It's about the anxiety of waiting 3 days for a check to clear when you need that money now. It's about the convenience of splitting a dinner bill instantly without exchanging account numbers. It's about the peace of mind that comes from getting real-time notifications about your spending instead of discovering an overdraft after it's too late. What I discovered during those 30 days completely changed my own banking habits. Before this experiment, I was like most Americans, vaguely aware that better options existed, but too busy or intimidated to make a change. I assumed that all banking systems were basically the same and that the differences were mostly marketing hype. I couldn't have been more wrong. By day 15, the differences were already stark. The traditional bank had charged me $18 in various fees, while my fintech alternatives had charged a grand total of $0. The high-yield savings app had already earned me more interest in 2 weeks than the traditional savings account would have in an entire year. And I'd spent nearly 3 hours dealing with traditional banking tasks that took minutes on my phone with the fintech alternatives. But the really eye-opening moment came when I calculated the projected difference over a year. If I kept $10,000 in these accounts, a reasonable emergency fund for many people, the gap between traditional banking and fintech alternatives would amount to over $450 in just 1 year, from a combination of higher interest, lower fees, and cashback rewards. And that doesn't even account for the time saved, which was worth at least another $200 based on average hourly wages. The question isn't just how much more money you'll make using fintech alternatives. It's how much you're currently losing by not using them. Think about it this way. If someone offered you $500 to spend a few hours setting up new accounts, would you do it? Because that's essentially the choice most Americans are facing right now. But maybe you're wondering if there's a catch. What about security? What about reliability? What about the comfort of having a physical branch you can visit? Those are all valid concerns, and I'll address each of them as we go deeper into my banking experiment. The traditional banking experience, death by 1,000 fees. Those valid concerns about fintech alternatives quickly faded when I got slapped with a $35 fee for buying a $4 latte. That's an 875% markup just for being $1 short in my account. Traditional banks aren't just failing to keep up with technology. They're actively profiting from your financial missteps in ways that would make most fintech companies blush. Let me walk you through what happened. It was day 7 of my banking experiment, and I stopped at my favorite coffee shop before heading to work. I swiped my traditional bank card without thinking twice, not realizing my balance had dipped to $3.96 after an automatic bill payment had processed overnight. Instead of declining the transaction, my bank helpfully covered the 4-cent shortage and then charged me $35 for the privilege. When I checked my account later that day, I nearly spit out the very coffee that had cost me $39.04. And here's the kicker. The bank processed the overdraft fee before processing a deposit I made that same morning. Had they processed transactions in chronological order rather than largest to smallest, a common banking practice, there would have been no overdraft at all. This isn't just my bad luck, it's by design. Big banks have perfected the art of fee extraction. In 2019 alone, the banking industry collected a staggering $15.47 billion from overdraft fees. That's billion with a B. And according to the Consumer Financial Protection Bureau, just 9% of account holders pay 79% of all overdraft fees. The system isn't broken. It's working exactly as intended, targeting those who can least afford these charges. After discovering the fee, I called customer service, where I waited 23 minutes before speaking to a representative. The call lasted another 45 minutes as I navigated through explanations, justifications, and eventually reached a supervisor who reluctantly waived the fee as a one-time courtesy. The entire ordeal took over an hour of my day, time I'll never get back. But overdraft fees are just the beginning. During my experiment, I discovered the traditional banking experience is riddled with charges hiding in plain sight. When I needed cash while out of town, I paid $3 to my bank plus another $2.50 to the ATM owner. That's $5.50 or 5.5% of my $100 withdrawal. That percentage would be outrageous for an investment fee, yet we accept it for simple cash access. Remember those wire transfer fees I mentioned? I had to send money to a friend who needed help with an emergency car repair. The $25 domestic wire fee represented 5% of the $500 I sent him. That's like paying a $15 fee to send someone $300. Completely unreasonable in an age of instant digital transfers. Even more frustrating was discovering that my traditional bank offers different fee structures based on account type. While I was paying $12 monthly for basic checking, other account types advertised as premium or preferred waived certain fees, but required much higher minimum balances of $5,000 to $25,000. The message was clear: banking convenience is reserved for those who already have substantial money. When reviewing my statements, I noticed several fees that weren't clearly disclosed when I opened the account. Paper statement fee, $2. Returned mail fee, for a statement sent to my old address, $5. Account research fee when I questioned a transaction, $25 per hour. The list seemed endless. What really caught my attention was how these fees targeted specific behaviors. Need to stop payment on a check. That's $35. Want a cashier's check? Another $10. Need a replacement debit card quickly? Express delivery costs $25. These services cost the bank pennies to provide, yet they charge dollars, sometimes dozens of them. Consider this. Americans pay an average of $329 annually in bank fees. That's enough to fund a decent emergency fund contribution, a nice weekend getaway, or several months of a streaming service subscription. And for what? For the privilege of accessing your own money. The psychological impact can't be overlooked either. Throughout my experiment, I found myself becoming anxious about using my traditional bank account. Every transaction came with the nagging question: will this trigger another fee? This created a totally unnecessary layer of financial stress. What makes this even more frustrating is the lack of transparency. My traditional bank's fee schedule was 14 pages long, written in dense legal language, and buried deep within their website. When I visited the branch to discuss fees, the representative handed me another pamphlet with yet more fees not listed online. It's as if they're playing a game of fee and seek. Meanwhile, on the fintech side of my experiment, I encountered exactly 0 unexpected fees. Every charge was clearly disclosed up front in plain language, and there were far fewer of them. No overdraft fees. No monthly maintenance fees. No minimum balance requirements. No ATM fees. In fact, my Neobank rebated ATM fees charged by other companies. What's particularly telling is how traditional banks respond when called out on these practices. When I questioned my bank representative about the overdraft fee, I was told I should have enrolled in overdraft protection, which ironically comes with its own transfer fee. The solution to fees, apparently, is more fees. The banking industry's reliance on fee income points to a broken business model. Instead of providing value that customers willingly pay for, they've created a system that profits from customer mistakes, inconvenience, and lack of financial sophistication. The Center for Responsible Lending found that overdraft fees disproportionately affect lower-income customers and communities of color, raising serious questions about banking equity. It's worth noting that even traditional banks are feeling the pressure from fintech competitors. Some have begun reducing or eliminating certain fees, but these changes often come with new restrictions or are only available to select customers. It's like they're giving with one hand while taking with the other. When I tallied up all the fees from my 30-day experiment, the traditional bank had charged me a total of $72, nearly 15% of my initial $500 deposit. Think about that. In what other industry would we accept losing 15% of our money just for basic service? The disappearing interest rate. Why your money isn't growing. If losing 15% to fees wasn't painful enough, here's another financial gut punch. While banks charge you for every little mistake, they're paying practically nothing for the privilege of holding your money. In fact, during my 30-day experiment, my remaining balance earned a whopping 83 cents in interest. Barely enough for a gumball, let alone keeping pace with inflation. That's right, after all those fees were taken out, my traditional bank rewarded me with less than $1 for the privilege of holding my money. This isn't just disappointing, it's financially devastating over time. Let's put this in perspective. With my traditional bank savings rate of 0.03%, it would take approximately 2,310 years for my money to double through interest alone. That's not a typo. Using the rule of 72, a simple formula where you divide 72 by your interest rate to determine doubling time, my money would double in value around the year 4,333. Long after you and everyone we know is gone. Even if we look at the national average savings rate of 0.43%, which is actually higher than what most big banks offer, your money would still take about 167 years to double. For comparison, during the 1980s, savings accounts regularly paid 5 to 12% interest, meaning your money could double in as little as 6 to 14 years. Today's rates aren't just low, they're historically embarrassingly low. The math gets even more depressing when we factor in inflation. With current inflation running between 3 to 4% annually, your money in a traditional savings account is actively losing purchasing power every single day. If inflation averages just 3% while your savings earns 0.03%, you're effectively losing 2.97% of your money's value each year. Let me make this painfully clear. $10,000 in a traditional savings account earning 0.03% will gain you about $30 in interest after a year. But that same $10,000 will lose about $300 in purchasing power due to inflation. You're not just standing still, you're moving backward at an alarming rate. During a conversation with a bank manager, when I was trying to get one of those fees waived, I asked why their interest rates were so low. His response: "We're competitive with other major banks." Translation: "We all agreed to pay you almost nothing, so where else are you going to go?" But here's what they don't tell you. While paying you pennies for your deposits, banks turn around and invest that same money for returns that dwarf what they're sharing with you. Through loans, investments, and other financial products, banks regularly earn 10 to 20 times what they pay depositors in interest. For example, while paying me 0.03% on my savings, the same bank charges 6 to 24% on credit cards, 3 to 5% on mortgages, and 6 to 36% on personal loans. Even factoring in operating costs and risk management, the math is clear. Banks are making a killing off the spread between what they pay you and what they earn with your money. This isn't just unethical. It's part of a business model that depends on your financial ignorance. Banks are betting that you won't notice or care about that fraction of a percent they're paying you. They're counting on inertia, the human tendency to stick with what we know rather than seeking better alternatives. The situation becomes even more frustrating when you realize this wasn't always the case. Before the 2008 financial crisis, savings rates of 4 to 5% were common. But as the Federal Reserve slashed interest rates to stimulate economic recovery, banks quickly lowered what they paid savers, but were much slower to reduce what they charged borrowers. When interest rates began rising again in recent years, banks were quick to increase loan rates, but dragged their feet on raising deposit rates. According to a study by the Federal Reserve Bank of Kansas City, this deposit rate stickiness has widened the gap between what banks pay depositors and what they earn, resulting in record profits for the banking industry. Let's visualize this. If you put $1,000 in a traditional savings account with a 0.03% APY, after 1 year, you'd have earned 30 cents. After 5 years, a whopping $1.50. After 20 years, just $6.17. And remember, this is before accounting for inflation, which would leave you with substantially less purchasing power than when you started. Now compare this to the current interest rates offered by top neobanks and high-yield savings accounts. While traditional banks are offering 0.01 to 0.05%, financial technology companies are offering rates between 3 to 5%. That's not a small difference. It's up to 100 times more interest on your money. With a 4.5% APY like what my high-yield savings app offered, that same $1,000 would earn $45 in the first year, 150 times more than the traditional bank. After 5 years, you'd have earned over $246 in interest compared to $1.50. After 20 years, the difference becomes staggering. Over $2,412 with the high-yield account versus $6.17 with the traditional bank. This massive gap exists because fintech companies have fundamentally different business models than traditional banks. With no expensive branch networks to maintain and more efficient digital operations, they can pass more of their earnings back to customers. Many operate on subscription models or make money through interchange fees when you use their debit cards, allowing them to offer higher interest rates as a competitive advantage. For example, neobanks like Ally, Capital One 360, and Marcus by Goldman Sachs consistently offer rates 10 to 30 times higher than traditional banks. Specialized high-yield savings platforms like Wealthfront and Betterment can go even higher, with some offering rates above 5% through various cash management strategies. The traditional banking industry has been able to get away with these absurdly low rates for two primary reasons: lack of consumer awareness and the perceived hassle of switching. They're counting on you not doing this math, or deciding it's not worth the effort to move your money even if you do. But here's the thing. In today's digital world, opening a high-yield account takes less than 10 minutes from your phone. Most platforms offer simple, free transfers from existing bank accounts, and many have eliminated minimum balance requirements and hidden fees. This isn't just about earning a few extra dollars in interest. It's about recognizing that your money is a tool that should be working for you, not against you. It's about understanding that by accepting traditional bank interest rates, you're essentially agreeing to lose money in real terms year after year. The time tax, how traditional banks steal your hours. Traditional banks aren't just taking your money through fees and low interest rates. They're stealing something even more precious. During my 30-day experiment tracking every banking interaction, I discovered a hidden time tax that's costing the average American hundreds of dollars in lost productivity each year. And unlike those visible fees on your statement, this cost never appears on any disclosure form. Think about your time for a second. What's an hour of your life worth? $25? $50? $100? Whatever that number is, traditional banks are silently charging you that amount over and over again without your permission. Let me break down exactly what happened when I tracked every minute spent on banking activities during my experiment. While managing my traditional bank account, I logged an astonishing 4 hours and 17 minutes handling basic financial tasks. Tasks that took mere minutes with fintech alternatives. The biggest time sink? Just trying to send money to friends. With my traditional bank, transferring $50 to a friend for dinner required logging into their clunky website, navigating through 5 different screens, entering their account and routing numbers, who memorizes those, confirming the transfer, and then waiting 3 business days for the money to actually arrive. Total time, 14 minutes to set up, plus the 3-day wait. My friend nearly forgot what the money was for by the time it hit his account. Compare that to the fintech alternative. Open app, tap friend's name, enter amount, hit send. Money arrived instantly. Total time, 8 seconds. Not minutes, seconds. Then there was the branch visit. When I needed a certified bank check for a security deposit, I had to physically drive to a branch, 15 minutes each way. Find parking, another 7 minutes. Wait in line, 23 minutes. And finally complete the transaction with a teller, 9 minutes. That's nearly an hour spent on something that could have been handled digitally in moments. The website experience was no better. Trying to generate a simple transaction report for tax purposes involved navigating through an interface that looked like it was designed in 2005. The session timed out twice during my attempt, forcing me to restart the entire process. What should have been a 2-minute task stretched into a 26-minute ordeal. Customer service calls were perhaps the most painful. When I spotted an unusual transaction, I called their helpline. After working through the automated system, 4 minutes. Waiting on hold, 19 minutes. Verifying my identity, 3 minutes. Explaining my issue, 2 minutes. Being transferred to another department, 5 minutes. Re-explaining my issue, 2 minutes. And finally resolving the problem, 7 minutes. I had burned through 42 minutes of my day. Even routine tasks like checking balances, transferring between accounts, and reviewing transaction histories took 3 to 4 times longer with the traditional bank's interface compared to the fintech apps. These small time differences add up dramatically over a month. But the real eye-opener came when I assigned a dollar value to this time. Using the national average hourly wage of $25, those 4+ hours of traditional banking activities cost me over $100 in lost productivity. That's on top of the actual fees they charged me. Even if you value your time at just $15 an hour, that's still $60 worth of your life spent dealing with banking inefficiencies every month. The psychological cost is significant too. Banking tasks with traditional institutions often create what psychologists call cognitive load, mental fatigue from dealing with complicated, frustrating processes. This drain on mental energy affects your productivity and decision-making in other areas of life. What makes this time tax particularly insidious is how it's designed to serve the bank's interests, not yours. Branch hours of September 5th Monday through Friday with limited weekend availability mean you're forced to handle banking during your workday. Their complex verification processes and multi-step security measures aren't primarily for your protection. They're designed to limit the bank's liability while shifting the burden of time and effort to you. Traditional banks are structured around a business model from the pre-digital era. Their physical branches, paper-based processes, and legacy technology systems create inherent inefficiencies that you pay for with your time. It's like being forced to use a rotary phone in the smartphone age. Technically functional, but ridiculously outdated. This outdated approach extends to how they handle your information. During my experiment, I needed to update my address. With the traditional bank, this required 1. Printing and filling out a form. 2. Providing 2 forms of ID. 3. Either mailing the documents or visiting a branch in person. 4. Waiting 5 to 7 business days for processing. The fintech alternative? 3 taps in the app, instantly updated. The bank's explanation for this disparity was telling. When I asked why certain processes couldn't be handled digitally, the customer service representative explained, "We have procedures that have been in place for decades to ensure security." Translation: we haven't bothered to update our systems even though the technology exists. What's particularly revealing is how banks market these inefficiencies as features rather than bugs. They'll tout their personal service and face-to-face interactions as benefits, when in reality, these are often just euphemisms for time-consuming and inconvenient. It's like a restaurant advertising that they make you wait an hour for your food as a way to build anticipation. The time tax isn't distributed equally either. If you're wealthy enough to qualify for private banking services, you'll have dedicated representatives handling your needs promptly. But for average customers, you're left navigating the maze of inefficiency on your own. This creates a system where those who can least afford to waste time end up wasting the most. During my experiment, I also discovered that traditional banks create artificial time pressures that fintech solutions eliminate entirely. For example, rushing to get to the bank before it closes, stressing about whether a deposit will clear in time to cover an upcoming payment, or needing to monitor transfer processing schedules. These small stresses accumulate into a constant low-level anxiety about timing that fintech apps simply remove from the equation. The difference becomes even more stark when you experience an actual problem. When I disputed a transaction with my traditional bank, I had to navigate a complex claim process that required multiple follow-ups and stretched over 2 weeks. The same issue with a fintech provider was resolved with a few taps and a resolution within 48 hours. Think about how this time savings compounds across your financial life. The average person conducts roughly 30 banking interactions monthly between checking balances, making transfers, paying bills, and making deposits. If each of these is just 5 minutes faster with fintech solutions, that's 2.5 hours. Fintech Revolution. Banking without the bank. Those 30 hours saved annually are just the beginning of what fintech can do for your financial life. While traditional banks trap you in their outdated systems, there's now a complete banking ecosystem that fits in your pocket, works around the clock, and actually puts your financial goals first. The banking revolution isn't something that's coming in the future. It's already available in your app store, ready to transform how you manage money. When I replaced my traditional bank with 3 simple apps for my experiment, I discovered something remarkable. Banking doesn't have to be a tedious chore that steals your time. It can actually be intuitive, fast, and dare I say it, enjoyable? Let me walk you through the 3 financial apps that completely changed my banking experience. First, I downloaded Chime, a popular neobank with over 12 million users. Unlike traditional banking apps that feel like clunky websites squeezed onto a phone screen, Chime's interface was clean, modern, and actually made sense. Everything I needed was accessible with 1 or 2 taps. No endless menu navigation or tiny buttons to squint at. The sign-up process was eye-opening. I completed my entire account setup in under 5 minutes while waiting for coffee. Compare that to the traditional bank experience, where I had to drive to a branch during business hours, find parking, wait in line, and sit through a 45-minute meeting with a bank representative who tried to upsell me on products I didn't need. Next, I added SoFi Money to my financial toolkit. This app combines high-yield checking and savings in one account with automatic saving features. What impressed me most was how it visually showed my spending patterns with color-coded categories that helped me instantly understand where my money was going. After 3 days of use, the app sent me a notification that shocked me. You've spent $83 on dining out this week. That's 30% more than your usual. This real-time feedback helped me make immediate adjustments to my spending, something my traditional bank statement never accomplished. The third piece of my fintech puzzle was Venmo for peer-to-peer payments. What traditional banks treat as a complicated wire transfer process, Venmo handles with the simplicity of sending a text message. When I needed to split a dinner bill with friends, I could pay my share instantly rather than promising to pay you back later when I could get to an ATM. But the real magic happened when I connected these apps to work together through open banking technology. This is where modern banking truly separates itself from the traditional model. Instead of one institution trying to handle all your financial needs, usually poorly, open banking lets specialized tools communicate with each other to create a customized system that works for your specific situation. Here's how I set it up. My paycheck direct deposit went into Chime, which automatically diverted 15% to my SoFi high-yield account. When I needed to pay rent, I could transfer money instantly between accounts without the 2 to 3 day waiting period my traditional bank imposed. For splitting costs with my roommate, Venmo connected directly to my Chime account for immediate funding. The entire system worked together seamlessly, with each app specialized for specific financial tasks rather than trying to be a mediocre one-size-fits-all solution like traditional banks offer. And because these apps talk to each other through secure APIs, application programming interfaces, I could see my complete financial picture in real time. Let's talk about another game-changing feature, real-time notifications. With my traditional bank, I'd find out about unusual charges when my monthly statement arrived or when my card unexpectedly declined. With my fintech setup, I received instant notifications for every transaction. When someone attempted to use my card number at a gas station in another state, I got an alert before the transaction was completed and could block it with one tap. These notifications completely transformed my relationship with money. I became more aware of my spending patterns and caught several subscription renewals I had forgotten about. My traditional bank would have happily kept charging me for services I wasn't using, but my Neobanks notification prompted me to cancel unnecessary subscriptions, saving me over $40 monthly. The security features of these fintech apps also impressed me. Despite what traditional banks might want you to believe, many fintech apps offer more advanced security than their legacy counterparts. I could instantly freeze my card from the app if it was lost, use biometric authentication instead of easily forgotten passwords, and set spending limits for different types of purchases. All features my traditional bank either didn't offer or buried in complex online banking menus. What makes this all possible is open banking, a revolutionary approach that's forcing traditional banks to adapt or die. Open banking refers to the practice of securely sharing financial data between different services with customer permission. This creates an ecosystem where specialized tools can work together instead of forcing customers to use a single institution's inferior products. In Europe, open banking has been mandated by regulations like PSD2, Payment Services Directive 2, while in the US it's being driven by consumer demand and market competition. The result is the same. Your financial data is finally working for you instead of being locked in a bank's silo. Here's what open banking means for your wallet right now. You can connect budgeting apps to automatically categorize your spending across all accounts. Payment apps can verify your balance in real time before making transfers. Investment platforms can analyze your cash flow to identify exactly how much you can safely invest. And lending services can instantly verify your income and spending habits to offer better loan terms than traditional banks. During my experiment, I used Plaid, a financial connector service, to securely link my accounts to Money Dashboard, a budgeting tool that gave me insights across all my finances. This allowed me to set more realistic savings goals based on my actual spending patterns. Within 2 weeks, I identified $127 in monthly expenses I could eliminate or reduce. Money my traditional bank's basic budget tools never helped me find. Open banking also powers automated savings tools like Digit, which analyzes your spending patterns and automatically moves small amounts of money to savings when you can afford it. During my test, this set and forget approach helped me save an additional $84 without feeling the pinch in my daily budget. The business model of these fintech companies also explains why they can offer better services. Traditional banks rely on customer confusion and inertia to profit from fees and low interest rates. Many fintech companies operate on subscription models, interchange fees from merchants when you use their cards, or they make money from interest rate spreads, but with much lower overhead costs since they don't maintain expensive branch networks. This transparent approach means they succeed when you succeed financially, rather than profiting from your mistakes or confusion. Some neobanks even share the interchange fees they earn with customers through cashback programs, effectively paying you to use their services rather than charging you fees. The flexibility of fintech also means you're no longer stuck with one-size-fits-all banking products. Like traveling internationally, get a neobank with no foreign transaction fees. Heavy cash user? Choose a fintech option that partners with ATM networks for free withdrawals. Need to build credit? Select a fintech service with built-in credit builder tools. This customized approach to banking would be impossible in the traditional model where banks try to force all customers into standardized products designed for their convenience, not yours. Money that actually grows, fintech interest rates and rewards. Traditional banks design their savings accounts to benefit themselves, not you. But what if your money could work as hard as you do? In just 1 month of my experiment, I earned $7.50 in interest through fintech platforms, which might not sound impressive until you compare it to the measly 83 cents my old bank would have paid on the same balance. That's 9 times more money without taking on any additional risk. When we project those numbers over a full year, we're talking about earning over $90 in passive income from fintech platforms versus barely hitting double digits with a traditional bank. And that's just on a $500 balance. Scale that up to your actual savings, and the difference becomes impossible to ignore. But where exactly is this extra money coming from? I discovered that several high-yield fintech platforms are consistently outperforming traditional banks by astronomical margins. Platforms like SoFi Money are currently offering interest rates around 4.6% APY, while Vero Bank provides up to 5% APY when certain conditions are met. There's also Port Banking, which advertises rates up to 4.25% APY, and T-Mobile Money, which gives qualifying customers 4% APY on balances up to $3,000. Compare those rates to my traditional bank's laughable 0.03% offer, and you'll see why I'm excited. Even the top-performing traditional banks rarely break the 0.5% threshold for their high-yield accounts. What's even more striking is how these fintechs maintain such competitive rates month after month. It's not a temporary promotion, it's their business model. They don't need to maintain expensive branch networks or support legacy computer systems from the 1980s. Most fintech companies operate entirely online, eliminating the overhead costs that traditional banks pass on to customers through lower interest rates and higher fees. Their streamlined operations mean they can redirect those savings to customers. A traditional bank might spend $2 to $4 million to build a single branch location, plus ongoing costs for staff, utilities, security, and maintenance. That's before factoring in their massive corporate headquarters and regional offices. By comparison, a neobank operates with a fraction of the physical footprint and staff, sometimes running their entire operation with fewer employees than a single bank branch. These savings aren't just theoretical, they translate directly to your bottom line. During my experiment, I noticed another financial advantage: cashback rewards that actually make sense. My neobank debit card offered a flat 2% cashback on all purchases, with no confusing categories or quarterly promotions to track. Over the 30-day period, I earned $8.32 in cashback rewards on my regular spending, something my traditional debit card never offered. Some specialized fintech debit cards take this even further. Services like Oxygen offer up to 5% cashback in specific categories, while Venmo's debit card provides up to 3% cashback at your most used retailers. The current debit card features points on purchases that can be redeemed for cash or merchandise, similar to a credit card rewards program, but without the temptation to take on debt. What really opened my eyes was calculating the total financial benefit of switching. Let's break down the numbers. First, the interest advantage. With a modest $10,000 in savings, The difference between a 0.03% traditional account and a 4.5% fintech account is $447 annually. Money that's literally appearing in your account while you sleep. Second, the fee savings. During my experiment, I was charged $72 in various fees by my traditional bank over just 30 days. That projects to $864 annually. Meanwhile, my fintech alternatives charged exactly zero in fees. Not a single penny. Third, the cashback rewards. My 2% cashback on regular spending added up to about $100 annually based on my typical monthly expenses. Traditional banks typically offer no cashback on debit purchases. Added together, we're looking at a potential financial advantage exceeding $1,400 per year for someone with modest savings and average spending habits. That's not pocket change. It's a significant boost to anyone's financial well-being. And remember, this isn't money you have to work extra hours to earn. It's simply the result of moving your existing money to more efficient financial tools. What about the effort involved? Moving your banking relationships sounds daunting, but I found the process surprisingly simple. Most fintech platforms have built streamlined onboarding processes that take minutes, not hours. They've engineered away the friction points that traditional banks seem to cherish. Many fintech companies even offer switch kits, guided processes that help transfer your direct deposits, automatic payments, and recurring transfers. Some will even identify your recurring transactions from your old accounts and help you update your payment information across multiple services. The cumulative impact becomes even more pronounced over time due to compounding. Let's say you keep $15,000 in savings and regularly spend $2,000 monthly on your debit card. Over 5 years, the difference between traditional and fintech banking could exceed $7,500 in your favor. That's a vacation, home renovation, or substantial contribution to your retirement account, all from simply changing where you keep your money. What fascinates me most is how fintech companies continue to innovate with hybrid products that traditional banks can't match. Wealthfront Cash, for example, offers both high-yield savings and basic investment options in one account. Betterment's Cash Reserve provides both emergency fund functionality and goal-based savings with visual tracking. These products blur the lines between banking and investing in ways that benefit customers. Some platforms are even incorporating roundup features that automatically save or invest the spare change from your purchases. During my experiment, these micro-savings added another $27 to my balance, small amounts that accumulate meaningfully over time without requiring budget changes. For those concerned about maximizing every dollar, there's a strategy called rate chasing, where you move your money between fintech platforms to capture promotional rates. While this requires more active management, some users report earning effective rates above 6% annually by timing their moves strategically. Just be aware of any account closure or inactivity fees before employing this approach. The real question becomes, with such clear financial advantages, why do people still use traditional banks at all? This brings us to the most common concern I hear whenever I talk about fintech alternatives: security. Many people wonder if these newer financial platforms are as safe as established banks with physical vaults and decades of history. The safety question: is your money secure in fintech? If the thought of moving your money to a digital-only platform makes you nervous, you're not alone. Security concerns remain the number one reason people stick with traditional banks. But here's the million-dollar question. In an age where even the biggest banks experience data breaches, are physical vaults and brick-and-mortar branches actually keeping your money safer, or just creating an expensive illusion of security? When I started testing fintech platforms, my family immediately bombarded me with warnings. But what happens if they go out of business? My mom texted. How do you know your money is safe without a real bank? My brother asked. These reactions highlight how successfully traditional banks have marketed physical presence as equivalent to security. During my experiment, I discovered something fascinating about how neobanks actually work with FDIC insurance. Unlike traditional banks that directly hold FDIC insurance, most neobanks partner with FDIC-insured chartered banks behind the scenes. For example, when you deposit money with Chime, those funds are actually held at Stride Bank or the Bancorp Bank, both FDIC-insured institutions. This means your money enjoys the same government protection up to $250,000 as it would at any traditional bank. But here's what traditional banks don't want you to know. This partner bank model actually gives some neobanks a security advantage. Many fintech platforms work with multiple banking partners, which can effectively multiply your FDIC coverage. During my test, I found that my SoFi Money account spreads deposits across up to 6 different partner banks, potentially increasing my FDIC insurance coverage to $1.5 million, far beyond the standard $250,000 limit at a single traditional institution. To verify this partnership model, I contacted customer service at 3 different neobanks and asked them directly, who actually holds my deposits, and what happens if your company goes out of business? All 3 explained that my money is held by their partner banks, not by the fintech company itself. If the fintech platform were to fail, my money would remain safe in those FDIC-insured accounts, accessible through the partner bank. Beyond deposit insurance, I tested the actual security features of both banking systems. First, I attempted to access my accounts from new devices. My traditional bank required only a username and password, while all 3 fintech platforms immediately triggered additional verification steps. My Vero account refused access until I verified my identity through my registered mobile device, adding a crucial layer of protection against password theft. When testing transaction monitoring, I deliberately made purchases in unusual locations. My neobank sent an instant push notification asking me to verify a coffee purchase made 50 miles from my home, allowing me to flag it as fraudulent with one tap if needed. My traditional bank, meanwhile, didn't notify me at all about the unusual transaction pattern. For biometric security, I compared login methods. My traditional bank's app did offer fingerprint login, but it was an optional feature I had to manually enable. In contrast, my neobank required biometric verification by default and offered additional options, including face recognition. When I attempted to disable these security features as a test, the neobank required a much more rigorous identity verification process to make these changes. What about fraud protection? This is where I found one of the most significant differences. My traditional bank offers zero liability protection, but with important limitations. Their policy states I must report unauthorized transactions within 60 days and can be held liable for up to $500 if I don't report quickly enough. The 3 fintech platforms I tested all offered more robust protection with no customer liability for unauthorized transactions, faster reimbursement timeframes, and simpler reporting processes. I was especially impressed by how Chime handled a test case I presented to customer service. I asked what would happen if someone somehow used my card without my permission. The representative explained their real-time transaction monitoring system and showed me how to instantly freeze my card from the app. When I mentioned that traditional banks offer similar features, the representative noted, "The difference is we typically detect and alert you to potential fraud before a transaction is even complete, while most traditional banks respond after the fact." What about actual data on financial fraud? According to the Federal Trade Commission's Consumer Sentinel Network, Americans reported losing over $5.8 billion to fraud in 2021, with identity theft and financial services fraud among the top categories. Interestingly, data from the same report shows that traditional payment methods like bank transfers and credit cards were involved in a higher percentage of fraud cases than newer payment technologies. A study from the University of Michigan even found that mobile banking apps from neobanks often implemented more consistent security measures than those from traditional banks. Their analysis of 15 banking apps revealed that fintech platforms were more likely to employ end-to-end encryption, automatic session timeouts, and multi-factor authentication by default rather than as optional features. To put these security features to a real-world test, I created a simple experiment. I deliberately triggered security alerts with both my traditional bank and my neobank by 1. Attempting to log in from a new device. 2. Making transactions in unusual locations. 3. Transferring unusually large amounts. 4. Changing my password multiple times in a short period. The neobank detected and responded to all 4 suspicious activities within minutes, requiring additional verification before allowing the actions to proceed. My traditional bank only flagged the large transfer, and even then, their response was a form email received hours later. What's particularly noteworthy is how the security models differ philosophically. Traditional banks often rely on reactive security, they investigate after something happens. Many fintech platforms employ proactive security, using artificial intelligence and machine learning to identify unusual patterns before fraud occurs. For instance, my neobank recognized when I made purchases at 2 locations 30 miles apart within 15 minutes, a physical impossibility that suggests potential card cloning, and immediately sent a verification request. So what should you look for when evaluating a fintech platform's security? Based on my experience, I've created this 5-point security checklist. First, verify their FDIC insurance partnership. Every legitimate neobank should clearly state which FDIC-insured bank holds your deposits. Second, examine their authentication options. The platform should offer at minimum 2-factor authentication, with biometric options like fingerprint or face recognition. Third, check their transaction monitoring capabilities. Look for real-time alerts and the ability to instantly freeze your account or card. Fourth, review their fraud protection policy. The best policies offer zero liability, quick reimbursement, and 24/7 reporting options. Finally, test their customer service with security questions. A reputable platform should be able to clearly explain their security measures and answer specific questions about how they protect your information. The evidence from my experiment suggests that many financial technologies are not just matching traditional bank security, they're exceeding it. Without the legacy systems and outdated infrastructure that many traditional banks struggle to update, fintech platforms are building beyond the hype from the ground up with modern threats in mind. Security might be fintech's foundation, but the real game changer is happening in your interest rate. Traditional banks offer pennies while crypto-powered banking alternatives are paying dollars. This isn't just another crypto bubble. It's the practical, everyday use for blockchain that actually benefits regular people without requiring you to gamble on volatile prices. When most people hear cryptocurrency, they picture Bitcoin roller coasters and meme coins, not practical banking tools. But beneath the speculative froth, there's a quiet revolution happening that's transforming everyday banking services through blockchain technology. And unlike the high-risk investments that dominate crypto headlines, these features are designed to make your money work harder while maintaining stability. Let's start with perhaps the most interesting innovation, stablecoins. Unlike Bitcoin or Ethereum, stablecoins are cryptocurrencies specifically designed to maintain a steady value, typically pegged 1:1 with the US dollar. This means $100 in USDC or USDT, 2 popular stablecoins, is always worth about $100, eliminating the wild price swings that make most crypto unsuitable for daily finances. The magic happens when you deposit these stablecoins with certain fintech platforms. While your traditional bank pays you that measly 0.03% interest, platforms like Nexo, BlockFi, and Celsius offer yields between 6 to 8% APY on dollar-backed stablecoins. That's not a typo. We're talking about interest rates that are 200 times higher than traditional banks, with similar stability to a regular dollar. How can they offer these rates? It's actually pretty straightforward. These platforms lend your stablecoins to institutional borrowers and traders who pay premium rates for access to cryptocurrency liquidity. The platforms then share a portion of that lending income with you. It's similar to how traditional banks operate, except they keep most of the profits for themselves instead of passing them on to depositors. During my experiment, I moved $100 into USDC stablecoins and deposited them with a regulated crypto platform. The interest accrued daily, unlike traditional bank interest that compounds monthly, and I earned $1.75 in just 30 days, an effective rate that would generate over $21 annually on that small $100 deposit. But impressive interest rates are just the beginning. Let's talk about what happened when I needed to send money to my cousin in Spain. My traditional bank wanted to charge me $40 plus a 3% currency conversion fee for an international wire. The total for sending $200 would have been around $46 in fees, nearly a quarter of the amount I was sending. Instead, I used a crypto-enabled fintech platform to convert dollars to stablecoins, transfer them across the blockchain, and have my cousin convert them back to euros. The entire process took under 10 minutes and cost a total of $3.50 in network fees. My cousin received the equivalent of $196.50 instead of $154 through traditional banking, a 27% improvement. Beyond transfers and interest rates, crypto-enabled debit cards are bringing blockchain benefits into everyday spending. Cards from companies like Crypto.com, Coinbase, and Gemini function exactly like regular debit cards, but offer rewards that traditional banks simply can't match. During my experiment, I used a crypto debit card for my grocery shopping and earned 4% cashback. Double what my neobank offered and quadruple what most premium credit cards provide. These cards also typically eliminate foreign transaction fees completely, making them ideal for international travelers. One afternoon, I tested both payment methods at the same grocery store. My $67.82 purchase with a traditional bank debit card earned me 0 rewards and would have incurred a 3% fee, $2.03, if I'd been abroad. The same purchase with a crypto-enabled card earned me $2.71 in rewards and would have had no foreign transaction fees. Of course, like any financial innovation, crypto banking features come with their own set of considerations. First and foremost is the regulatory landscape. While traditional banks operate under well-established regulatory frameworks, crypto platforms operate in a more evolving regulatory environment. Some platforms are now obtaining state money transmitter licenses, but oversight varies significantly. Security is another critical factor. The best crypto banking platforms offer the same security features as traditional fintech: two-factor authentication, biometric verification, and insurance on deposits. However, not all platforms are created equal. Some offer third-party insurance on digital assets, while others have no protection beyond their own security measures. Then there's the tax situation. Unlike traditional bank interest, which requires just a simple 1099 INT form at tax time, crypto interest and rewards may trigger more complex tax reporting requirements. Every crypto-to-crypto or crypto-to-fiat exchange is technically a taxable event that needs to be tracked and reported. During my experiment, I used crypto tax software to automatically track my transactions and generate the necessary reports. The software identified that I had a total of 17 taxable events from my crypto banking activities, resulting in about $4 in reportable interest income and no capital gains, since I primarily used stablecoins. There's also a learning curve to consider. Even with user-friendly interfaces, understanding concepts like blockchain confirmations, gas fees, and wallet addresses requires some initial education. I spent about 30 minutes learning the basics before I felt comfortable using crypto banking features confidently. So what cryptocurrency features should you actually care about for everyday banking? Based on my experiment, focus on these 4 practical applications. First, stablecoin savings accounts for higher yields on emergency funds or short-term savings. These accounts offer significantly higher interest rates while maintaining dollar stability. Second, crypto debit cards for enhanced rewards on everyday spending and fee-free international transactions. The best cards require no cryptocurrency knowledge. They handle all conversions in the background. Third, international money transfers, especially to countries with volatile currencies or limited banking infrastructure. Crypto transfers can be faster, cheaper, and more accessible than traditional wire transfers. Fourth, automatic recurring investments, which let you gradually build positions in digital assets over time. This dollar-cost averaging approach reduces timing risk and integrates investing into your regular banking activity. What you likely don't need for everyday banking: speculative cryptocurrencies, complex DeFi protocols, or NFTs. These might have their place in an investment portfolio, but they introduce unnecessary volatility and complexity into day-to-day finances. The most surprising discovery from my experiment was how seamlessly crypto banking features integrated with traditional finance. I didn't need to choose between old and new. I could use stable, regulated on-ramps to access blockchain benefits without abandoning traditional banking entirely. Money without borders, the P2P Payment Revolution. Traditional banking might be playing catch-up with crypto, but there's an even more dramatic revolution happening right under our noses, the peer-to-peer payment revolution. Remember the last time you needed to pay a friend back for dinner? The difference between using a traditional bank and a modern P2P app isn't just about convenience. It's fundamentally transforming how we think about exchanging money with the people around us. When I sent $50 to my friend Jamie during my experiment, the contrast couldn't have been more stark. With my traditional bank, I needed Jamie's account number and routing number first. information most of us don't casually keep in our contacts list. After filling out a form with all those digits, I had to verify the transfer with a code sent to my phone, confirm I understood the transfer policy, and then wait. 3 full days later, Jamie finally received the money. Now compare that to my experience using a P2P payment app. I opened the app, typed Jamie's username, the same one she uses on social media, entered $50, added a pizza emoji in the notes, tapped send, and quite literally before I could put my phone back in my pocket, Jamie texted me that she'd received it. Total time elapsed? 8 seconds. This isn't just a small improvement. It's a complete transformation of what we expect from financial transactions. The major players in this space have carved out unique positions. Venmo, with over 70 million active users, has become almost synonymous with casual money transfers. Its social feed, which shows a public record of transactions, minus the amount, has turned payments into a social experience. I've seen friends use the notes field for everything from inside jokes to passive-aggressive reminders about shared expenses. Cash App, backed by Square, now Block, has leaned into the intersection of banking and culture. They've embraced Bitcoin integration and gained massive popularity through influencer marketing and their Cash App Friday giveaways on social media. Their unique approach has helped them capture a younger demographic that traditional banks struggle to reach. Zelle takes a different approach, operating directly within existing bank apps. This integration gives it a sense of institutional backing that appeals to more security-conscious users. In 2022, Zelle processed over $490 billion in payments, more than Venmo and Cash App combined. But what's truly fascinating is how these platforms are transforming our social dynamics around money. Splitting a restaurant bill used to be an awkward calculation of who ordered what, followed by someone inevitably saying, "I don't have cash, can I pay you back later?" Now, I've watched entire groups automatically divide bills with a few taps before they even leave the table. Group payments have evolved too. When my friend organized a weekend cabin getaway, she created a collection through Cash App where everyone could contribute their share. The app tracked who had paid and automatically notified stragglers, removing the uncomfortable task of reminding friends about money they owe. Requesting funds has also become remarkably frictionless. When my roommate spotted an unexpected $82 utility bill increase, she sent payment requests to everyone in our apartment within seconds. No more awkward conversations or handwritten IOUs taped to refrigerators. The numbers behind this transformation are staggering. According to eMarketer, P2P payment users in the US have grown from 69.2 million in 2019 to over 120 million in 2023. The total transaction volume has exploded from $379 billion to an estimated $1.2 trillion in the same period, a 216% increase in just 4 years. The demographic breakdown is equally telling. A survey by Early Warning Services found that 75% of millennials and 69% of Gen Z use P2P payment apps at least once a week, compared to just 32% of baby boomers. For anyone under 35, these apps aren't just a banking feature, they're an essential social utility. But this revolution isn't without its challenges. The seamless experience comes with trade-offs that users should understand. Privacy concerns top the list for many. Venmo's public transaction feed has led to uncomfortable situations, from revealing who someone had dinner with to accidentally exposing sensitive purchases. While you can set transactions to private, many users don't change the default settings. I've personally witnessed a friend discover her boyfriend was paying for dinners with someone else through Venmo's public feed. Not how anyone wants to find out about relationship issues. Accidental payments are another real risk. The frictionless nature of these apps means mistakes happen faster too. During my experiment, I nearly sent $500 instead of $50 because of a simple typo. Unlike traditional bank transfers, where multiple verification steps might catch such errors, P2P apps prioritize speed over confirmation steps. Once money is sent, it can be difficult to get it back without the recipient's cooperation. This leads to perhaps the biggest downside: dispute resolution. With traditional banks, you can typically stop a payment or dispute a fraudulent transaction. With P2P apps, once money leaves your account, retrieving it often depends entirely on the goodwill of the recipient. If you accidentally send money to the wrong username, or worse, get scammed, your options for recovery are limited. The Federal Trade Commission reported that scams involving P2P payment apps increased by 156% from 2019 to 2022, with the average loss per victim climbing to $440. Many users don't realize these platforms offer significantly less protection than credit cards or even traditional bank transfers. Some apps are addressing these concerns. PayPal and Venmo have introduced purchase protection for certain transactions, while Zelle emphasizes its security features through bank partnerships. But the industry is still playing catch-up with consumer protection standards that have been established for decades in traditional banking. Despite these challenges, the trajectory is clear. P2P payments are becoming the default way people exchange money. Banks recognize this shift, which is why many have invested heavily in Zelle as their answer to fintech competition. But the integration often feels bolted on rather than built from the ground up for modern users. What's particularly interesting is how these platforms are expanding beyond simple money transfers. Venmo and Cash App now offer debit cards connected to your balance, cryptocurrency trading options, and even direct deposit capabilities. They're not just changing how we send $50 to a friend. They're becoming comprehensive financial ecosystems that challenge the fundamental purpose of traditional checking accounts. For everyday users, the advantages are compelling. No more waiting days for money to transfer, no need to remember bank account numbers, and a social layer that makes financial interactions feel more human. The ability to instantly split costs has even changed social dynamics around money, making it easier to maintain fairness in relationships without awkward conversations. When you still need a traditional bank, the hybrid approach. Those seamless P2P payments might have you ready to ditch your bank entirely. But what happens when you need to deposit a large cash gift, secure a mortgage, or access a safety deposit box? The smartest approach isn't choosing between old and new. It's knowing exactly when each option serves you better. After all the downsides of traditional banking we've explored, you might be wondering why anyone would keep a regular bank account at all. The truth is, while fintech has revolutionized most everyday banking needs, there are specific situations where that brick-and-mortar institution still holds unique advantages that no app can replace, at least not yet. Let's talk about cash. It might seem outdated, but there are moments when you'll have physical currency that needs a home. Maybe your grandma gave you $500 for your birthday, or you sold your old furniture for cash. Neobanks simply don't have physical locations where you can deposit cash directly. Some offer workarounds like depositing at partner retailers or purchasing money orders, but these options often come with fees or daily limits that traditional banks don't impose. Need a certified check for that security deposit on a new apartment? While digital payments are becoming more accepted, many landlords, government agencies, and educational institutions still require certified funds for large transactions. Walking into a branch and getting a cashier's check on the spot saves you from the multi-day wait many online banks require. Safety deposit boxes remain firmly in the traditional banking world. If you have valuable jewelry, important documents, or collectibles that need secure storage, physical bank vaults offer protection that no digital service can match. These temperature-controlled, disaster-resistant vaults provide peace of mind for irreplaceable items that cloud storage simply can't replicate. Relationship-based services also give traditional banks an edge. When you need a mortgage, having an established relationship with a bank can sometimes lead to better terms or faster approvals. The loan officer who knows your financial history might be more willing to work with you than an algorithm that only sees your credit score and income. This personal touch becomes especially valuable when you have unique circumstances that don't fit neatly into automated approval processes. International banking still favors traditional institutions in certain situations. If you're traveling to countries where cash is king, having a bank that can provide foreign currency exchanges or emergency cash services can be invaluable. Many neobanks offer great international features for card transactions, but they can't help when you need physical foreign currency before a trip. But here's the crucial insight. You don't need to choose just one system. The most financially savvy approach is adopting a hybrid model that leverages the strengths of both worlds while minimizing their respective weaknesses. My personal hybrid strategy evolved throughout my 30-day experiment. I've kept a stripped-down traditional bank account with minimal features, just enough to maintain access to essential services without triggering fees. By meeting the basic requirements, a small direct deposit portion, and maintaining the minimum balance. I avoid monthly maintenance charges while retaining access to physical branches when needed. For my day-to-day banking, I've shifted almost entirely to fintech alternatives. My paycheck gets split. A small portion goes to the traditional bank to meet requirements, while the majority flows directly to my high-yield account. All recurring bills, everyday purchases, and person-to-person transfers happen through fintech platforms, where I benefit from higher interest, better rewards, and zero fees. This hybrid approach creates a powerful financial ecosystem. When I need to deposit a cash gift from a relative, I use my traditional bank. When I travel internationally, I leverage my crypto-enabled debit card for fee-free spending. My emergency fund sits in a high-yield account earning actual interest, while my checking account at the Neobank gives me instant access to funds with cashback rewards on purchases. To implement your own hybrid strategy, start by auditing your banking needs. Make a list of every banking task you've performed in the past year and categorize them. Which ones genuinely require a traditional bank, and which could be handled more efficiently through fintech alternatives. The decision framework I use asks 3 simple questions. First, does this task involve physical cash or in-person services? Second, would I save significantly on fees or earn better interest by using a fintech alternative? Third, am I comfortable with the security measures of the fintech option for this particular task? For maintaining a minimal traditional bank account without fees, look for institutions with easily achievable waiver requirements. Some banks waive monthly fees with direct deposits as low as $250, a single monthly debit card purchase, or by maintaining a modest minimum balance. Credit unions often offer better terms than megabanks and still provide the physical services you occasionally need. The key is being intentional rather than inertia-driven. Most people stay with inefficient banking setups because change seems overwhelming. But by taking a strategic approach, moving services one at a time, you can build a hybrid system that saves money without sacrificing convenience. By 2025, the list of banking tasks that absolutely require traditional banks will likely shrink even further. Already, some neobanks are partnering with retail locations to accept cash deposits. Digital mortgage approvals are becoming mainstream. Even notary services are going digital in many states. But for now, a streamlined traditional account remains valuable for a large cash deposits and withdrawals, safety deposit boxes, instant cashier's checks and money orders, in-person notary services, complex mortgage applications, banking services while traveling to less developed regions, joint accounts with specific legal protections. Everything else, from daily spending to saving for goals, from earning interest to sending money to friends, typically works better, faster, and more profitably through fintech alternatives. The most powerful insight from my experiment wasn't that one system completely outperformed the other. It's that strategic combination creates a financial setup greater than the sum of its parts. By keeping a minimal traditional banking presence while embracing fintech for everyday needs, you get the best of both worlds. The established security and specialized services of traditional banking paired with the higher returns, time savings, and user-friendly experience of modern fintech. The $1,000 verdict, your financial freedom blueprint. Beyond the theoretical benefits of a hybrid approach lies the cold, hard cash reality. When I tallied up all the savings from my 30-day experiment, from eliminated fees to higher interest rates to time saved, the financial impact was so significant it forced me to question why I hadn't made these changes years ago. What would your financial freedom blueprint look like with an extra $1,000 a year? Let's put everything on the table and see what our experiment revealed. After 30 days of splitting my banking between traditional and fintech options, the numbers tell a compelling story. While my traditional account was bleeding money through fees and earning practically nothing in interest, my fintech alternatives were generating actual returns with zero fees. Looking at a 5-year projection based on these results is even more eye-opening. For someone with average savings of about $15,000 and monthly spending around $2,500, the difference adds up to over $9,000. That's a family vacation every year, a decent used car, or a significant chunk of an emergency fund, all from simply changing where you keep your money. But I get it, switching your entire financial life over to new platforms feels risky. That's why I've developed a 5-step approach that lets you test the waters without diving in headfirst. Step 1. Start with a single high-yield savings account. Move a small portion of your savings, $500 to $1,000, to a platform like SoFi or Wealthfront. This is the lowest risk entry point with the most immediate payoff. Step 2. Try a no-fee checking alternative alongside your existing account. Keep your traditional checking open while setting up a neobank like Chime or Current. Use the neobank for discretionary spending to test its features without disrupting your bill payments. Step 3. Experiment with a P2P payment app for friend and family transfers. This doesn't touch your core banking, but gives you experience with digital money movement. Step 4. Set up automatic transfers to gradually shift your banking activity. Start with 10% of your paycheck going to your new accounts, increasing the percentage as your comfort grows. Step 5. Review your experience after 60 days. Evaluate what's working and what isn't, then adjust your strategy based on real-world results. Before you start this journey, use this evaluation checklist for any fintech platform you're considering. Security. Does it offer FDIC insurance through a partner bank? Is two-factor authentication mandatory? Can you instantly freeze your card if needed? Do they use encryption for data transmission and storage? Fee transparency. Is their fee schedule easily accessible and understandable? Are there hidden conditions that might trigger charges? Do they clearly explain how they make money if they don't charge fees? Customer service. What support channels do they offer? What are their hours of availability? How quickly do they typically respond? Check social media and review sites for real customer experiences. Regulatory compliance. Is the company properly registered with financial authorities? Have they faced any significant regulatory actions? Do they clearly explain how they handle your data? Operational history. How long have they been in business? Have they had any major outages or security breaches? Do they have a track record of financial stability? User experience. Is the interface intuitive and accessible? How easy is it to find important information? Can you accomplish common tasks with minimal steps? Now, let's talk about the most strategic way to transition your banking activity. The key is gradual implementation, moving one financial function at a time rather than everything at once. Week 1. Open your high-yield savings account and transfer a small test amount. Week 2. Set up your neobank account and link it to your existing bank. Week 3. Route a portion of your direct deposit to your new accounts. Week 4. Start using your new debit card for everyday purchases. Week 5. Set up bill payments through your new account, starting with a small, non-essential bill. Week 6. Increase your direct deposit allocation to the new accounts. Week 7. Review your experience and adjust your strategy. Different financial situations call for different fintech combinations. Here are 3 tailored recommendations. For young professionals with student loans, combine SoFi, offering both high-yield banking and student loan refinancing, with Capital for automated savings and Robinhood for beginning investments. For families managing multiple goals, Ally Bank provides competitive rates with multiple savings buckets for different goals, paired with Greenlight for teaching kids about money and Enab for family budgeting. For freelancers and small business owners, Mercury or Novo for business banking with built-in invoicing tools, combined with Catch for tax withholding and retirement savings. The long-term impact of making this switch extends far beyond just immediate savings. Think about the compound effect. By earning real interest instead of paying endless fees, your money grows exponentially over time. The difference between earning 0.03% and 4.5% on $20,000 over 20 years is over $24,000. That's real wealth-building potential from a simple banking choice. There's also the psychological freedom that comes with banking on your terms. No more working around limited branch hours, waiting on hold for customer service, or wondering if you'll get hit with a surprise fee. Your money becomes something you control rather than something that controls you. Financial independence isn't just about how much money you have, it's about your relationship with that money. Traditional banks have designed a system where they hold all the power and customers follow their rules. The Fintech Revolution flips that dynamic, giving you tools that work for you rather than against you. What's the actual difference between Fintech users and traditional bank customers? Financial flexibility. When your money is earning meaningful returns instead of sitting idle, when you're not paying hundreds in unnecessary fees, and when you can access and manage your finances on your terms, that creates true financial freedom. The most powerful advantage is having your money actually work for you. Traditional banking is designed to extract value from your money through fees while providing minimal returns. Fintech platforms reverse this equation, giving you the lion's share of the value your money generates. This isn't just about numbers in an app or higher interest rates. It's about reclaiming power from institutions that have held your money hostage for generations. Traditional banks have built their empires on your deposits while giving almost nothing in return. The beauty is you don't need to make a dramatic overnight switch. Take one small step this week, maybe opening a high-yield savings account or downloading a fee-free payment app. Keep your traditional account active while you explore. Even this minimal change can put hundreds of dollars back in your pocket within months. Remember, financial freedom isn't just for the wealthy or tech-savvy. It's your money, working harder for your dreams instead of funding someone else's.